Today, extend and pretend some more. Hello again, it's Martin North from Digital Finance Analytics World. Latest post covering finance and problem news. Well, the AFR reports that Commonwealth Bank will cut the interest rate stress test for some borrowers refinancing their mortgages from 3% higher than the market rate to 1%, despite warnings from regulators that the higher figure was appropriate to protect from economic uncertainty and risks. The lower buffer will apply to refinancing applications submitted from Friday, and it will only apply to borrowers who have not missed repayments in the past year and where the loan is less than 80% of the property's value. The refinanced loans must be more than a year old. The change has been made to help borrowers who have found themselves unable to refinance because they no longer meet the higher buffer hurdle following a rapid increase in interest rates. That issue has become known as the mortgage prison and could affect up to 13% of loans. The CBA decision was made after consultation with APRA, who declined to comment on Wednesday afternoon. Due to the current interest rate environment, some homeowners are facing challenges refinancing their home loans, so we are introducing an alternative interest rate serviceability buffer of 1% for select customers, said Michael Baumann, an executive with the bank. The move is expected to help CBA win more loan refinancing in a period where large numbers of loans are rolling off low fixed interest rates. Westpac made a similar change to its buffers last month, when it reduced the 3% buffer to 1% for some customers with solid credit history. It did this in consultation with APRA, which has urged banks to make only limited exceptions. The Reserve Bank, of course, has lifted the cash rate 12 times in the past 13 months. That's the most rapid tightening cycle in a generation, from 0.1% to 4.7%. And that means that some 880,000 loans written at low interest rates will transition onto more expensive rates later this year alone. Lendy, the owner of Aussie Home Loans, expects nearly half of its loan book to transition to their variable period before the end of the year. The rate rises will also raise the prospect of so-called mortgage prisoners who are unable to switch loans because the increase in rates and falls in property prices over the past 13 months may mean they no longer pass the stress testing hurdles against which banks must assess loan applications. National Australia Bank's basic variable home loan rate is 6.24%, meaning that it would assess if potential borrowers can repay at 9.24%. Barrenjoey analyst John Mott says the potential for financial stress is building for these borrowers. We expect mortgage arrears to rise sharply over the next 12 to 18 months as these customers revert to higher interest rates. CBA said its decision was made after consultation with APRA, which declined to comment on Wednesday, and applicants will also have to submit themselves to full income, expense and liability verification. The amount being refinanced cannot be greater than the existing loan, and the reduced buffer will not apply to guarantor or property share scenarios, bridging loans, construction loans, loans involving any government guarantee scheme, or any consolidation of unsecured debt. Rating agencies are watching these moves relating to serviceability buffers. Alicia Trey, an analyst at S&P Global Ratings, said some non-bank lenders had also reduced buffers from between 2.5% and 3% to 1%, and non-bank lenders, of course, are not regulated by APRA. In recent months, we've seen a small number of lenders announce they might approve refinance loans with an interest rate buffer as low as 1%, she said during an investor briefing on Tuesday. Some lenders appear to be approving these loans on the exception basis only, rather than actually changing their credit policy. And S&P said they'd identified some banks who'd moved to a 2% buffer for all new loan assessments, not just refinancing, adding that some had engaged with the credit ratings agencies on how to reduce the documentation required to support loans from self-employed borrowers. S&P said that reductions to serviceability buffers in exceptional circumstances would not affect its view of bank mortgage risk. The Council of Financial Regulators, a committee made up by officials from the RBA, APRA The Australian Securities Investment Commission and Treasury last week said that the serviceability buffer of 3% was still appropriate. Council members supported APRA's assessment that the serviceability buffer remains at the appropriate level given the current environment, including the high degree of uncertainty and risks to the economic outlook, it said. But of course, what the bank wants to do is to continue to lend and be in a competitive position to lend more. And also, of course, by reducing the serviceability buffer, what it means is that they essentially can declare more loans okay. So this is another example of extend and pretend. And frankly, to my mind, the 3% serviceability buffer still makes a lot of sense because rates can still go quite a lot higher from where they are. And if you've only got a 1% buffer, that may not be enough. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.